You're in tune to the Paperflip Real Estate Podcast.
You're in a tough spot. The mortgage feels heavier every month. The bank calls don't stop. And the word foreclosure is a nightmare that keeps you up at night. It's stressful, it's isolating, and it's completely overwhelming. In the middle of all this, someone probably suggested what sounds like a perfect escape hatch, which is a short sale. They likely told you is way better than a foreclosure, a dignified way to get you out from under the debt while minimizing the damage. Sounds like the responsible thing to do. But what if that escape hatch is actually a trapdoor? What they probably didn't tell you is that a short sale can be a financial minefield. It's a process that can drag on for months, sometimes over a year, leaving you in a painful state of limbo. It can still hammer your credit, and worst of all, it can leave you with a surprise tax bill or even a lawsuit from your lender for the leftover debt. Before you sign anything, before you commit to this path that seems like your only way out, and we need to talk. We need to pull back the curtain on the hidden dangers of a short sale and discuss what you can do to actually protect your financial future. This isn't just about dodging foreclosure. It's about making a choice that lets you truly rebuild, not just trade one nightmare for another. Before we get into the traps, let's quickly define what a short sale is. Now, on the surface, it's pretty simple. Short sale is when you sell your house for less than what you own the mortgage. Now, for this to happen, your lender has to agree to accept that short payment and let the sale go through. So, for example, say you owe $300,000 on your mortgage, but the best offer you can get in the current marketplace is $250,000. That's a $50,000 shortfall or deficiency. In a short sale, you ask your lender for permission to sell the home for $250,000 and have them accept that as settling the debt. This is usually pitched as a win-win-win. You avoid the public notice of a foreclosure, the buyer gets the deal, and the bank avoids a costly legal process. Sounds clean and logical, but this simple picture has a maze of complications and potential financial pain that rarely gets mentioned up front. Real trouble with a short sale is buried in fine print, and those details can be brutal for a homeowner already under enormous stress. So let's discuss some of the hidden traps of a short sale. This is where we get into the heart of things. This is where we look past the sales pitch and at a harsh reality. A short sale is often sold as the lesser of two evils, but in many cases, it's just a slow-acting poison. Let's break down the biggest hidden traps. So let's get into trap number one, the excruciating timeline and the illusion of control. Now, first off, the name short sale is a joke. There's absolutely nothing short about a short sale. A normal home sale might close in 30 to 60 days, but a short sale, well, get ready for a marathon. It can easily drag on for months, and it's not uncommon for it to last over a year. The holdup is in the chain of command. It's not just your main mortgage lender who needs to approve it. Now, if you have a second mortgage or any other liens, every single one of those have to agree to these terms for the short sale. This creates a bureaucratic nightmare. Each bank, each insurer, each lien holder has its own sets of rules and its own timeline. One no anywhere in that chain can blow up the whole deal, sending you back to square one. Meanwhile, you're the one stuck in the middle, buried in paperwork while your financial clock is ticking. This brings us around to the illusion of control. You might be listing a house and showing it to buyers, which feels kind of proactive. But the truth is, you have almost no power. The bank has the final say. They can reject a great offer for their own internal reasons. They can counteroffer, or they can just ghost you and your buyer. Now imagine finding a patient buyer, spending weeks in negotiations only for the bank to kill the deal over a few $1,000s. It happens all the time. This long, drawn-out uncertainty is exhausting. You can't move on with your life, and the threat of foreclosure is still hanging over you. Now, if the short sale fails, and many of them do, you wasted precious time and now closer to foreclosure than ever before. So here's trap number 2. This is the complicated truth about your credit. You need to go over that, and this is real important. Now, here's one of the biggest misconceptions about short sales, that it's a get-out-of-jail-free card for your credit. And that's simply not true. Now, let's be clear. A short sale will cause a major negative hit to your credit score. Now, is it better than a foreclosure? Generally, yes. Most experts and lenders view a short sale most favorably because it shows you're proactively trying to solve the problem. But however, less damaging does not mean harmless. Now, your credit score can still drop significantly, often by 100 points or more. The account will be marked as settled for less than the full amount, which is a serious red flag for future lenders that will stay on your report for about 7 years. The key advantage often lies in your ability to recover. Now, after a short sale, the waiting period to qualify for a new mortgage can be shorter than after a foreclosure. Depending on the loan type and your circumstances, you might be able to get a new FHA or conventional loan in as little as 2 to 4 years compared to a wait of up to 7 years after foreclosure. But this isn't a guarantee. It requires you to be perfect with your credit going forward. Don't let the idea of saving a few credit points distract you from the other bigger risks that we're about to go over, which we're going to trap number 3 here, which is the potential tax nightmare. This is the trap that can blindside you long after you moved out. It's called cancellation of debt income. So let's go back to our example. You owe $300,000. The house sold for $250,000, and the lender forgave the $50,000 difference. Now, here's a brutal twist to the whole situation. Now, the IRS can treat that forgiven $50,000 as taxable income. That's right, taxable income. The government can view that phantom money as if you earned it, and your lender may send you a 1099-C tax form. Now, suddenly, you could owe thousands in taxes on money you never even saw right when you're most financially vulnerable. Now, there's been a law in place to kind of help mitigate this. The Mortgage Forgiveness Debt Relief Act has often allowed homeowners to exclude this forgiven debt on a primary residence. Now, this protection was extended through the end of 2025. However, these particular protections have always been temporary, requiring Congress to renew them again and again. So relying on a temporary tax law that could expire is a very huge gamble. And plus, the rules can be kind of complicated, and it generally only applies to your main home, not any rental or vacation property. A simple mistake on your taxes could trigger a costly audit. This is a ticking time bomb that many people don't see coming. So let's get into trap number 4, which is the deficiency judgment ambush. This is easily the most dangerous trap of them all. When the bank approves the short sale, you might assume you're free and clear. That is a catastrophic assumption. Now, unless the approval letter from your lender specifically says in writing that they are waiving their right to pursue a deficiency. They can still come after you for that money. Now, using that example, that's the $50,000 shortfall. Now, if you don't have a deficiency waiver, the bank can sell your house and then sue you for that remaining $50,000. And if they win, they get a deficiency judgment against you. This isn't just a bill, it's a legal weapon. With a judgment, they can garnish your wages, seize money from your bank accounts, and put liens on your other assets. It's a debt that will follow you for years. The laws on this vary wildly from state to state, and some states offer protections, but others give lenders a clear path to sue you. In a cruel twist, some state laws might protect you from a deficiency after a foreclosure, but leave you totally exposed after a short sale. Getting that waiver in writing is everything. You have to do that. Have to get that in writing so that you're covered. Because without it, you're just trading your house for a massive unsecured debt. So let's go into a reality check here, acknowledging the pros. One way to look at short sales. Now, it's not all bad for everyone in every single situation. Now, to be fair about it, there are a few reasons why a short sale might seem appealing, and you need to know what they are. So first, it does avoid a public foreclosure auction, which for many is a huge relief. It's a more private process that can feel less like a repossession and more like a regular sale. And then second, the lender often agrees to pay the seller's closing costs and realtor commissions. For someone with no cash, this can be a big deal. And finally, some programs even offer a few $1,000s in relocation assistance. And sometimes we call this cash for keys. And this is to help you move out so you can get a restart at a new location. But you have to weigh these perks against the massive risk that you might be taking on. A few $1,000s for moving doesn't help much if you get hit with a $50,000 lawsuit in that example, or a giant tax bill. Now, these pros are often just shiny distractions from a much bigger hidden trap. So here's some safer alternatives, the real lifelines that can help you out. Now, the biggest myth out there is that it's either a short sale or a foreclosure. But it's just simply not true. Lenders would almost always rather have a paying loan than a foreclosed property. I'd like to see you paying on a loan. They're not in the business of taking on houses. You have a better, safer option to explore in terms of doing a short sale. There's some other alternatives and some other things that you could do besides doing that short sale. And one I've discussed here on the program oftentimes, one is a loan modification. Now, this should be your first call if you want to stay in your home. A loan modification permanently changes your mortgage terms to make your payments more affordable for you. Now, the lender might lower your interest rate or extend the loan term from 30 years to 40 years, or in some cases, even reduce the principal balance that you owe. And the goal is to get your payment down to something that you can actually afford. This is the best case scenario because you get to keep your house. Then second, you can do a forbearance agreement. Now, if your financial problem is temporary, let's say you lost your job or you had a medical emergency. Now, forbearance is a great tool for you to use. It's a temporary pause or reduction in your mortgage payments, usually for a couple of months. It gives you the breathing room you kind of need to get back on track, to get back on your feet. Now, you'll have to pay the missed payments back. You will have to do that, but the lender will typically work with you on a repayment plan. You can do also what's called a deed in lieu of foreclosure. If you can't keep the home, a deed in lieu of foreclosure can be a much cleaner exit than a short sale. Basically what this is you voluntarily sign a property title over to the lender, and in exchange for that, they can cancel the mortgage. Now, the big advantage is that the negotiation is just between you and the bank. And there's no buyer to deal with, no commissions, no waiting for a sale to close. You can often negotiate a deficiency waiver as part of the deal also, giving you a clear break from the debt. While it still hurts your credit, it's kind of controlled and it's predictable. And it's a process instead of the chaos of dealing with a short sale. So you want to choose a real recovery and not these hidden traps. Now, facing mortgage trouble is incredibly stressful, but you don't have to go through this alone. The choice you make right now will impact your financial life for the next decade. It's a serious decision, a serious choice to make. So think back, where we started in the beginning here. A short sale was presented as the best way out for you. But now you see it's a path filled with some hidden traps. Still not a bad thing. It can still be helpful, but there are some hidden traps you just need to be aware of. You need to consider these things. It's a grueling, uncertain process where the bank holds all the cards. It comes with a significant credit hit. The risk of a surprise tax bill could be laying in the waits for you, and the very real threat of a deficiency judgment that could haunt you for years. So it can still come up, you can still garnish your wages for this deficiency judgment, and you can have some IRS consequences as a result. Now, real recovery, it lies in the alternatives here. Now, a loan modification can keep you in your home. Forbearance can give you time to get back on your feet. And with a deed in lieu, it can offer a much cleaner exit. Your financial future is too important to bet on the false promises of a short sale. And this is something you don't have to do. You definitely consider some of these alternatives, a loan mod or a forbearance or a deed in lieu. Those are some alternatives besides doing a short sale. And ultimately, if you owe more on your home than what is worth, a short sale might be a viable option if none of these other options are good for you. So take a step back, take a deep breath, and explore some of these safer options first. Talk to a nonprofit housing counselor or real estate attorney or real estate agent or realtor that knows how to navigate these troubling waters. And by doing that, make an informed decision and choose a path that leads to a genuine recovery for you, not just another financial trap. This has been Lloyd for Real Estate on the Paper Flip Podcast.